Morning, Tom. So overall, I think it's each asset class for itself. I'm looking at equity markets right now, some reaction in terms of the futures, but I don't think there's going to be too much in the grand scheme of things. Foreign exchange, much more interested in where dollar yen is going, and maybe there's going to be more of a knock-on effect on the Treasury market. So we're in a wait-and-see mode there. And of course, US Treasury markets focusing on the inflation aspects as well. So individual drivers, not one unique force at this pace, but overall, I think markets will take this in its stride.
Over the weekend, Jeff, and this is your wheelhouse, there was a lot of discussion about linear and nonlinear movement in yields, which comes back to the belief in fixed income, in this case of worry, price down and yield up. Are we at a point where yields trip and we get a real accelerative tendency to higher yields?
I think that's the broader fear. But if I look at the last few trading days, there's much more concern about Japan intervening and the stronger dollar causing Asian reserve managers in general, and those in the GCC, mind you, due to the need for dollar preference, will they need to sell US Treasuries? That, it seems to be much more of a driver compared to the inflation shock. So we are looking at the Treasury market. We are looking at these drivers, but probably these triggers are not where we expect them to be. But that confluence of factors is something the market's certainly attuned to and worried about higher yields.
So, Geoffrey, we have seen some movement over the past week or so, pronounced movement in the Japanese yen here, pushing up to the 160. Now we see it back down to 157 here. What do you think is going on in that market?
So two things really. One, inflation expectations. Inflation numbers actually softening in Japan, but I guess it's a unique environment right now and high base effects. Inflation expectations due to the oil shock, of course, that is driving things higher. But finally, the market is saying you've warned about intervention. The Ministry of Finance said this is a final warning, and lo and behold, they actually came in. So now that they've put the money, where their mouths are, let's see, whether this can drive broader, stronger APAC currencies in general. This is one of the most favored positions in currency markets at the beginning of the year. Renminbi's anchoring things, of course, balance of payments shifting a bit, but now with the yen move, this could be one of the bigger themes for the rest of the year. And this is good for the US, by the way, greater purchasing power for Asia to buy US assets.
Geoffrey Yu with us with BNY. What you heard there, folks, was a really sophisticated, as you'd always get from Jeff Yu, idea of yield guessing inflation versus flows. Right now, Jeff Yu is Chairman Warsh and the Federal Reserve central banker to the world, and that if the Japanese have troubles or any other nation, it is swaps to the rescue.
Well, the US will help itself. The most amazing thing we've seen in US Treasury markets this year are clients, our US clients in our data, they are buying US Treasuries at phenomenal amounts. Actually, domestic clients in Europe, domestic clients in the UK, they are buying their own debt in phenomenal amounts. Why? I look at the break even, I look at the inflation break even, barely moved, right? So your real yields are tremendous right now. For an aging population, this is happening all over the Western world. I wouldn't be worried about the Treasury market at all with real yields at these levels.
This is brilliant, folks. Can we get him back?
He's pretty good, isn't
he? I mean, if the Red Sox win 3 in a row, Geoffrey Yu will come back.
Exactly.
Maybe if Tottenham stays out of relegation, they'll come back. Jeff Yu, this is just so important here. If you look at the 10-year real yield, however you measure it, how out of whack is it because of insatiable war demand for our full faith and credit debt?
Well, right now, it's the break-evens. I'm just looking at the 10-year right now. They're barely above levels where we were a year ago, right? So, holding well about 2.5%, yet nominal yields are higher. So I think there is this absolute belief that the AI trade will push up US productivity, the productivity differentials. And sometimes it's about differentials versus the rest of the world. It'll be so strong versus the rest of the world such that inflation is not now and will not really be a problem for the foreseeable future. So yes, you can have a supply shock. AI and productivity growth in the US will be able to deal with it. And this is helping domestic investors who don't have to worry about FX anchor the US Treasury market as well. So as things stand, I really don't worry about the US Treasury market either.